Options. What is an option? Options are financial instruments that are derivatives based on the value of underlying securities such as stocks. A lot of the stuff that I'm gonna go through in here, the lingo might be real deep. I'm gonna break it down in the simplest forms, but I have to read it because these are the definitions. So an options contract offers the buyer the opportunity to buy or sell depending on the type of contract they hold, the underlying asset. Unlike futures, the holder is not required to buy or sell the asset if they choose not to. So you literally have an option to purchase the stocks. You don't have to buy them. I know a lot of people see people day trading stocks online. They have to actually purchase the stocks before like right when the market opens, or have them already in their account, and then they trade with what they have. They can use leverage. They can, use margin and all that other stuff. We'll get into that as well. But that's not a requirement when you're dealing with options. You're literally dealing with a contract, which is an agreement between you and the seller that you're going to purchase the 100 shares at a specific date for a specific price. You do not have to uphold that agreement. All right. So let's move on. Two different types of options, contracts we're going to go over: call options and put options. So a call option allows the holder to buy the asset at a stated price within a time frame. Put allows the holder to sell the asset at a stated price within a specific time frame. So if I think that the stock price is going to go up, I'm going to get a call option. If I think the stock price is going to go down, I'm going to get a put option. Those are the differences. All right. Those are the two basic ways for you to invest in the trade. All right. So call options mean you think it's going to go up. Put options mean you think it's going to go down. All right. So each option contract will have a specific expiration date by which the holder must exercise their option. The stated price on an option is known as the strike price. Options are typically bought and sold through an online or retail broker. So that's what we talked about with Robinhood. That is the broker. That's the brokerage account you're going to have. Okay. The expiration date is on each contract. So there's going to be columns and there's going to be columns for you to choose from depending on which date you want to choose your option contract in. All right. Option contracts, depending on what stock you're using, they're going to be a whole lot of them, which is high volume, or it's not going to be that many. I'm gonna want you to start focusing on ones that have high volume. The reason why is because if the volume is low, it's going to be hard for you to sell your contract. So remember, there's an expiration date. So once you start getting closer to that expiration date, if you don't want to exercise the option and actually buy those 100 shares, you got to get rid of it. You got to get that off. You got to sell it. And if the volume is low, you might not have the opportunity to sell it to anybody. Nobody might want it. There's not a lot of people interested in the stock. So you got to make sure that the volume is high. You want to be able to get in and get out. All right. So you want to focus on popular companies, trending companies, stuff like that. Even sometimes companies that a lot of people don't know about might have a lot of high volume, you know what I'm saying? But you'll be able to see all of that in the Robinhood app. You literally can see it. So when you open up the stock, I'm gonna pull up my account so you can see it too. But when you open up the signal and you can see the option contracts available, it's gonna be a long list or a short list. You feel me? And the volume is gonna be visible before you actually get to the option contracts as well. You can see the volume, and it's usually in the millions and billions. You want to make sure that you in the higher range and you have a whole lot of contracts available. You want to be able to get in and get out. All right. Yeah, the strike price. Okay. The strike price is the price that you're going to agree to purchase these shares at. Remember, each contract is representative of 100 shares. Okay. So if you purchase one option contract, that's giving you the option to purchase 100 shares of that stock. So you have to multiply by 100. So the strike price will be there along with the expiration date. Let's say, for instance, the strike price is 20. You just agreed to purchase 100 shares for $20 a piece. So you have to take $20 times 100. That's how much money you're going to spend to purchase 100 shares. you got to have that money in your account if you want to exercise that option. If you don't want to exercise that option, you got to make sure that you get rid of that contract before the expiration date. You feel what I'm saying? All right, so key takeaways. All right, so options, obviously options are financial derivatives that give you the right, but not the obligation to buy or sell the underlying asset at an agreed upon price and date. Call options and put options form the basis for a wide range of option strategies designed for hedging income or speculation. Although there are many opportunities to profit with options, investors should carefully weigh the risk. So I'm talking about speculation right now. Speculation meaning I'm getting in and I'm getting out. I have no desire to purchase these shares for real. I just want to get the contract and I want it to raise value so I can get my ROI. And then I'm going to sell the same contract to somebody else for more money than I bought it for. I'm going to take my money. I'm going to get my difference. The difference is mine. And then I'm going to move on and go about my business. I don't want nothing to do with the actual company. All right. So I'm going to give you a few examples to look at. But that's what that is, speculation. As far as hedging, for hedging, that means that I actually own the 100 shares. So when you actually are an investor and you have 100 shares of that company, you can protect your position using option contracts. So let's say, for instance, I'm an investor in a company like Black Stocks Tube. We're a publicly traded company. I got 100 shares. All right. I don't know what's going on with this website. I don't know what's going on with the owner. I don't know what's going on with them. I think the stock price might go down. I want to protect myself by putting an option contract out at a higher strike price. So that way I can see if somebody wants to agree to purchase my shares for higher than what I paid for them for at a later date. So if the stock price goes down, they already agreed to buy them from me. I'm not going to lose no money. You feel what I'm saying? So that's how investors for the long term protect themselves with the positions that they already have in place. You feel me? And then you can always cancel that contract if you don't want to deal with it no more. You could buy it back, all that type of stuff. We'll get into that too. All right. Understand options. So options are a versatile financial product. These contracts involve a buyer and a seller where the buyer pays the options premium for the rights granted by the contract. Each call option has a bullish buyer and a bearish seller, while put options have a bearish buyer and a bullish seller. So for those of y'all who don't know, bearish and bullish. So bullish means you think the price is going to go up. Bearish means you think the price is going to go down. All right. So there's two sides of the game. So if you think the price is going to go up, then you're going to buy a call option. The person that's selling it to you might have a different opinion and think it's going to go down. They might be bearish. You feel what I'm saying? Vice versa for the puts. Option contracts usually represent 100 shares of the underlying security, and the buyer will pay a premium fee for each contract. For example, if an option has a premium of 35 cents per contract, buying one option will cost $35. So again, you're timesing everything by 100. We're going to look at the real example so you can see it, but just so you could read it right here. One option contract will have a premium. The premium is what you're going to pay. That's how much you're going to spend. So it might be 35 cents. So when you open it up and you see, damn, it's only 35 cents. Yeah, it's 35 cents times 100. You feel what I'm saying? So it's like you have to do that times 100. You're not going to get away with just paying $35. It has to be 35 cents. It has to be 35 cents times 100. That's how much you're going to pay. That's how much money you need to have in the game right away. You don't need to have the full amount of the strike price in your account when you purchase the option contract. Robinhood, whatever platform that you're using, they're not going to require you to have all that money outright in your account. But you do need to have that $35 though. Feel me? So all you need to come into the game with is that price times 100. Okay. The premium is partially based on the strike price, the price for buying or selling the security until the expiration date. All right. So another factor in the premium price is the expiration date. Just like with a carton of milk in the refrigerator, the expiration date indicates the day the option contract must be used. The underlying asset will determine the use by date. For stocks, it is usually the third Friday of the contract's month. So you can back to what I was saying about volume, right? So if you're dealing with a stock that has very, very high volume, you're going to see that they have a lot of contracts out. You might be able to get a contract every single week for that specific company with an expiration date. The expiration date might be every single week. So if you wanted to, you could do 1 or 2 contracts every single week and just have that income coming in with small risk if you wanted to do it like that. Some companies that have low volume, they might have only 1 contract or 1 expiration date per month. You know what I mean? It depends on the company and the volume. So you want to deal with high volume companies so that way you can make sure that not only will you be able to get in and get out whenever you need to, but you'll have an opportunity to make some income every single week before the expiration date. Sometimes what I do is I'll wait until like Wednesday just to see what happened throughout the week. So if the momentum is going down for the whole week and I look at it on Wednesday, I'm like, okay, this thing been going down all week. I doubt it's going to flip back up before Friday. Expiration date is Friday. I got 2 days to make some money if I decide to get a contract with an expiration date like that, or I could get one with an extended expiration date for the next Friday, but still see the momentum. So I'm like, all right, my expiration date might not be until next Friday, but if I get it today on Wednesday, I can let it go this Friday and it still hold a lot of value. Okay, we're going to get into the value of timing and all that stuff a little bit later, but that's just a strategy for you to think about. The expiration date is very important. The closer you get to the expiration date, the less valuable that contract is. If you look at my stories and my highlights, I give you the screenshots of the contracts that I've had. Sometimes my expiration dates be like 1 day before I sold it. Sometimes it'd be a couple months until I sold it. You know what I'm saying? Depends on how I'm feeling, depends on how quick I'm moving. You know what I mean? Sometimes you'll make a mistake. It happens. You'll be ready to jump into something so quick and I got an expiration. The expiration date is in 2 days. I'm tripping. You still might be able to make money if you're on the right side of the market. So just keep that in mind. Expiration date is very important. Traders and investors will buy and sell options for several reasons. Option speculation allows a trader to hold a leveraged position in an asset at a lower cost than buying shares of the asset. So that's what we talked about, speculating. Investors will use options to hedge or reduce the risk exposure of their portfolio. We talked about that. For people who actually own the shares, they can protect themselves. In some cases, the option holder can generate income when they buy call options or become an options writer. That's a little bit more advanced, but we're gonna get into that too. For options traders, an options daily contract volume and open interest are key numbers to watch in order to make the most well-informed investment decisions. So trading volume and open interest, those are 2 things that you want to be relatively high to make sure that you can get in and get out without no problems. I've had people in the past, and this is not the first course that I've taught, I've had people in the past wanted to be pro-Black and got options contracts for Black-owned companies that are on the stock market, publicly traded. Great idea. We all want to support. But understand, if the trading volume is low and the open interest is low, which it probably will be because they're Black-owned companies, you know, it just is what it is. They bought an option contract, the stock price shot up, profited 10 bands, couldn't sell the contract. It wasn't enough open interest, it wasn't enough volume. They literally could not sell the contract. So I told them, like, it's okay because you made the right move. You was on the right side of the market. You might not be able to jump on that profit by selling your contract, but you could exercise it if you got the money. Just go ahead and buy the shares and become an investor. So if you exercise the contract, now you get assigned those 100 shares, and then you become a holder of the company. But the stock price went up, you just got all that gain anyway. So you ain't lose nothing. But if you coming in with the mindset of I'm about to get in and get out without actually owning the shares, you only able to do that if the volume is there for you to get in and get out. So keep that in mind. All right, American options can be exercised anytime before the expiration date of the option, while European options can only be exercised on the expiration date of the exercise date. Exercising means utilizing the right to buy or sell the underlying security. I don't know if we got anybody in here that's located in Europe or not, but the price, the rules are different. So we specifically dealing with American options. We don't really have that issue. Expiration date, as long as you do what you got to do before that date, you can maneuver. And then the exercising, I just said that, exercising. So you'll see that option. Do you want to exercise this option? Exercising the option means I'm gonna take you up on that offer and go ahead and buy these shares off. You know what I'm saying? So if you want to exercise the option, that's what that means. Okay. If anybody is involved in real estate, you'll know that this is very, very similar to real estate. So if you look at an example like someone that's trying to buy or sell a house, right? You know that when you're in the market and you're trying to buy a house, you can't just walk up to somebody and say, here's the money, give me the crib. You have to have a sale contract. The sale contract, you got the due diligence period, 30 days, you put the earnest money down, the same concept. So let's say, for instance, you're trying to buy a house and you have the sale contract, you're supposed to close on this house in 30 days, right? Closer and closer you get to the expiration date, your options are limited. You feel what I'm saying? So if you're dealing with wholesaling and stuff like that, you know that contract is valuable. You sign the paperwork saying that you're gonna exercise this, but you don't have to do that. You paid for the contract with the earnest money. You feel what I'm saying? So sometimes that earnest money is refundable. Sometimes it's non-refundable, depending on what type of contract you're dealing with. But if you're wholesaling, you know that you can take that contract if it's value in it, and you can go ahead and resell that to somebody else. You know what I'm saying? Make your money on the spread without having to deal with actually buying the crib. Same concept. You just dealing with stocks. You know what I'm saying? So those are for y'all that who are involved in real estate. Same thing. It's just an agreement. All right. Options, risk, metrics, the Greeks. This is the most complicated stuff that people have issues with. For me personally, I only pay attention to a few of these. I'm not going to tell you to do what I do. You should be well informed about everything. All right. But when you open up your Robinhood app or your Webull app or whatever you decide to use, you're going to see all of these numbers and these names and these percentages and these decimals. And it looks confusing, but I'll break it down for you so it's simplified. Just know that it's not 100% necessary for you to pay so much attention to the Greeks. It could confuse you, but there are things about them that you need to be aware of. So the Greeks is a term used in the options market to describe the different dimensions of risk involved in taking an options position, either in a particular option or a portfolio of options. These variables are called the Greeks because they are typically associated with the Greek symbols. Each risk variable is a result of an imperfect assumption or relationship of the option with another underlying variable. Traders use different Greek values such as delta, theta, and others to assess option risk and manage option portfolios. So let's get into it. All right, delta. Delta is, I pay attention to that, okay? Delta represents the rate of change between the options price and the $1 change in the underlying assets price. I think somebody, hold up 1 second. Make sure you mute it. Make sure everybody's muted. I can't see right now. All right, so in other words, the option sensitivity of the price sensitivity of the options relative to the underlying delta of a call option has a range between 0 and 1, while the delta of a put option has a range between 0 and -1. For example, assume an investor is long on a call option with a delta of 50. Therefore, the underlying stock increases by $1. The option's price would theoretically increase by 50 cents. So basically, the delta is pretty much showing you where your profit is at. You dig what I'm saying? So when you're looking at the delta of a specific contract, it's telling you if the price moves up $1, this is how much your profit is going to be. Multiply that by 100, and that's your profit. So if you pull up an option contract and it says that the delta is 0.50, multiply that times 100, and then assume that the stock price goes up $1, and that is going to be your profit for a $1 gain. All right, that's what delta is. So if you have a put option, it's the opposite. You feel me? So you're going to see negative numbers. It's going to be -1 to 0. Multiply that one by 100, and there you go. Just know that as the stock goes, if you have a put option and the stock goes, the price of the stock goes down, you're profiting on the way down. So it's going to look weird because it's going to be negative numbers when you're looking at it. But when you open up your brokerage account and you see it, it's going to say positive if you're in a profit. All right. It looks confusing, but once you get the hang of it, it makes perfect sense. All right. So for options traders, delta also represents the hedge ratio for creating a delta neutral position. For example, if you purchase a standard American call option with a 40 delta, a 0.40 delta, you will need to sell 40 shares of stock to be fully hedged. Net delta for a portfolio of options can also be used to obtain the portfolio's hedge ratio. So this is for people who actually own the shares. Right now, we're not dealing with that, but a less common usage of an options delta is its current probability that it will expire in the money. For instance, a 0.40 delta call option today has an implied 40% probability of finishing in the money. So not only can you look at delta and say, all right, this is going to be my profit if it raises $1 or goes below $1. You could also look at delta and say, okay, this is the probability of the contract expiring in the money upon this expiration date. We're going to get into in the money and out the money calls, in the money and out the money puts in a minute, but just keep that in mind. All right. Theta is another one that I definitely pay attention to. All right. Theta represents the rate of change between the options price and time, or sensitivity, sometimes known as an options time decay. Theta indicates the amount of options price if it would increase as the time expires. So basically what that means is the closer it gets to expiration date, the less and less your contract is worth. Theta actually shows you the amount of money you're losing. You feel what I'm saying? So for example, assume the investor is long on an option with the theta of 0.50. The options price would decrease by 50 cents every day that passes, all else being equal. If 3 trading days pass, the options value would theoretically increase by $1.50. Okay, so when you look at the contract and it says 50.50 or 50 cents, multiply that by 100, and just know that each day we go, you're subtracting that from your potential profit. Feel what I'm saying? So you're losing money as it gets closer and closer to the expiration date. Also, you need to keep in mind, with all this being in consideration, just know that I know some people be like, well, all I gotta do is get a long expiration date and I ain't gotta worry about it. The farther you go, the more expensive those contracts will be. So you have to keep that in mind. So when you're looking at the option chain, you're gonna see, I can get a contract that expires in 2022, but how much is it gonna cost me? How much do I have to put at risk? I can get a contract that expires next Friday. You know what I'm saying? It's cheaper, but I gotta be sure about what I'm doing, because if I'm on the wrong side of the market, I can't be waiting for it to turn around, because the longer I wait, the more money I'm losing. So you gotta be right and pretty much on point with what you're guessing. And I'm gonna show you a strategy that you can use to at least make sure that you're getting movement within that period of time that you have the contract. All right. Theta increases when options are at the money and decreases when options are in and out of within the money. Options closer to expiration have an accelerating time decay. Long calls and long puts will usually have negative theta. Short calls and short puts will have positive theta. By comparison, an instrument whose value is not eroded by time, such as a stock, would have 0 theta. So really basically what it's saying is you're only going to be dealing with theta if you're dealing with options contracts. You're not dealing with theta if you actually own the stock. And then, so gamma is, gamma works hand in hand with delta. So I don't necessarily pay too much attention to gamma, but gamma is like an extra bread for you. You feel me? You pretty much add that to your delta. So gamma represents the rate of change between the options delta and the underlying asset price. This is called the second order or second derivative price sensitivity. Gamma indicates the amount of delta that would change within a given $1 move in the underlying security. For example, assume an investor is long on one call option on a hypothetical stock XYZ. The call option has a delta of 0.50 and a gamma of 0.10. Therefore, if the stock XYZ increases or decreases by $1, the call options delta would increase or decrease by 0.10. So basically, if the stock price goes up $1, you got the 0.50 times 100 plus the 0.10 times 100. So you adding that to your profit. You know what I'm saying? So that's, I don't pay too much attention to it, but you know, it can be beneficial. All right. Gamma is used to determine how stable an option delta is. Higher gamma values indicate that delta would change dramatically in response to even small movements in the underlying price. Gamma is higher for options than they are at the money and lower for options that are out of the money, and accelerates in magnitude as expiration approaches. So just expiration date is very important. Everything is critical when it gets closer to the expiration date. You pretty much you have to be 100% right if you're gonna wait all the way until your expiration date. You gotta be really in the money. You gotta be really like profiting, you feel me? I have examples in my highlights to where I literally sold an option contract the day of or a day before and still made money. I will buy a contract on Thursday and or like a Wednesday and let it go on Friday and still be in the money because I know where it's going. You feel me? And I'll show you a strategy to where you can pretty much, it's not a guaranteed situation, but you can at least see where your target should be at. So as long as you have a target price, you can wait for it to hit your target price or let it go before it hits your target price. And then you can kind of look at your ROI and judge whether you want to get in and get out. Sometimes I just get ones with short expiration dates because I just be knowing, you know, and it works out. But just know that it's very critical. That time decay, that is very critical. Options traders may opt to not only hedge delta, but also gamma in order to be delta gamma neutral, meaning that as an underlying price moves, the delta will remain close to zero. So there's different strategies that you can use to make sure that you hedge whatever you're doing. I'm gonna show you a strategy on that. All right, Vega represents the rate of change between the option's value and the underlying asset implied volatility. This is the option sensitivity to volatility. Vega indicates the amount of an option's price changes given 1% change in implied volatility. For example, an option with a Vega of 0.10 indicates the option's value is expected to change by 10 cents if the implied volatility changes by 100. So when you open up your options chain and you look at the contract specifically, you're gonna see the implied volatility percentage there. That's why I don't really pay too much attention to Vega, because the implied volatility is there too. So you'll see the percentage there. So implied volatility, basically what that is how volatile is the actual stock right now. So you'll see with the strategies that I'm gonna show you, depending on the events that's going on in the market, the volatility might be high as hell. So like you just saw what happened with AMD and GameStop and all those companies. If you pull up an options chain for GameStop a couple of days ago, the implied volatility would probably be like 300% or something crazy like that. Whereas prior to all this news, it might have been at like 30% because it's not volatile, it's really not moving too much. That's basically what that means. The price's movement is implied that it's going to be high or low. You know what I mean? The more volatility you have, the more range of price movement you're going to be dealing with, potentially. It's not 100% true. It is potential. All right. Because increased volatility implies that underlying instrument is more likely to experience extreme values. A rise in volatility will correspondingly increase the value of an option. Conversely, a decrease in volatility will negatively affect the amount of the option. Vega is at its maximum for at the money options that have longer time until expiration. So basically, the implied volatility might be super high if the expiration date is far out and it's already at the money. So when you're at the money, that means that you're very, very close to where the price is at right now. So if the stock price right now is $35, you're at the money if your price range is around $35. If the expiration date is way far out, then anything can happen within that period of time. So you might have an event coming up, like an earnings call or something like that. That would increase the volatility of the stock. You feel me? Or the volatility of the contract. Okay. So, all right. So gamma is, did we go over this? I think we went over this one. Yeah, so we did that one. All right, cool. Fast fact, those familiar with Greek language will point out that there is no actual Greek letter named Vega. There are various theories about how the symbol, which resembles the Greek letter in U, found its way in the stock trading lingo. This ain't really got nothing to do with nothing. But if you're interested in the Greeks and you're interested in that type of stuff, you can do some research and see the similarities and try to compare the Greek mythology and the characters in Greek mythology to the actual things that we just spoke about. There's actual characters that you can put them, you can compare them to, and they can play those positions if you choose to take it that far, but it ain't that necessary. Rho, I don't really pay much attention to this at all, but you need to know it. Rho represents the rate of change between an option's value and a 1% change in the interest rate. This measures sensitivity to the interest rate. For example, assume a call option has a rho of 0.05 and a price of 1.25. If interest rates rise by 1%, the value of the call option would increase to $1.30. All else being equal. The opposite is true for put options. Rho is greatest for at the money options with long times until expiration. So if you get an option contract that has a very, very long expiration date, and you're dealing with the economy, you can look at it like, okay, I spoke about this in my stories as well. We talk about Jerome Powell and the Fed and everything that's going on with the government and them putting the stimulus into the economy and all that. If you look at the value of the dollar, you see that the value of the dollar is decreasing. All right. Every time they pump stimulus into the economy, it makes the value of the dollar go down. We didn't work for the money. We're not producing anything. We're just consuming. So they give us more money. We don't take that money and produce nothing. We just take it and go spend it at Walmart and all these other companies, whatever. We spend the money. You feel what I'm saying? So the less that we produce and the more that we consume, the worse that it's making our economy. And this is really the only solution right now that they have for us just to keep the economy moving. All right. So when they give us money, it has a positive effect and a negative effect. One, it's allowing us to continue with our lives, but two, it's decreasing the value of the dollar. So as the dollar decreases in value, the only way that they're able to counteract this is with quantitative easing and interest rates. So when the interest rate rises, then it will have an effect on your options contract. So that's why Rho is important if you're dealing with option contracts that have an expiration date for a year or 2 or 3 years ahead. The rise in interest rates can decay the value of your option contract if you play in that game. You feel what I'm saying? Inflation. Somebody said my volume is low. Can y'all hear me? Y'all good? All right. So the inflation, all that stuff that comes into consideration when you're talking about dealing with the interest rate. As the interest rate rises, inflation will rise. Inflation basically means that the cost of living is going to get higher. So all this stuff they're talking about right now with doing the $15 increase to the minimum wage and all that stuff, they're not about to just give us money like that. You know what I'm saying? They're gonna the price of living is gonna go up as the extra money is being pushed out. So if you're dealing with long-term options, you might want to pay attention to the Rho. I don't really pay attention to the Rho because I don't deal with option contracts that have that much long of an expiration date. But minor Greeks, some other Greeks that aren't discussed as often are lambda, uh, epsilon, voma, vera, speed, zoma, color, ultima. These Greeks are second or third derivatives of the pricing model and affect things such as change in delta with the change in volatility and so on. They are increasingly used in options trading strategies on computer software and can compute and account for these complex and sometimes esoteric risk factors. So when you pull up Robinhood, you're not even really going to see none of this stuff. I think you can customize it so that you can see this stuff, but more than not, you're probably not going to see it. And I don't even really pay attention to it. It's really not that deep. All right. But you should be aware of everything. Okay. Risk and profits from buying call options. As mentioned earlier, the call options let the holder buy an underlying security at the stated strike price by the expiration date called the expiry. The holder has no obligation to buy the asset if they do not want to purchase the asset. The risk to the call buyer is limited to the premium paid. Fluctuations of the underlying stock have no impact. So you're going to lose what you put in. That's it. It don't go beyond that. You feel me? So if you've seen a contract and it say you got 35 cents for this contract, multiply that times 100, that $35 that you put up is the only amount of money that you're putting at risk. All right. So if you got $35 you want to risk and you lose completely, that's all you're going to lose. If you happen to get into an option contract or in a position and you put $35 up and it's going against you, and you don't want to wait until the expiration date to where the value, not only the value of your contract decreases, but your money also is disappearing as well, you can sell that contract and get out of it and cut your losses before you just let all of that money go. So sometimes I'll get into a position and I'm losing money. I might have an expiration date that's like 2 weeks out. I'll get out of that and then get back in a better position, because I didn't risk that much money. You know what I'm saying? And I didn't wait that long, and I didn't let my whole $35 go either. You know what I'm saying? So you can protect yourself with that and just know that you're only risking what you put up. All right. Some ways that you invest, dealing with leverage and, you know, the way day traders move around and these short sellers and stuff that you was hearing about with the GameStop situation, just to break that down a little bit. You know, hedge funds, they have large accounts that they deal with. They got a lot of money that they managing. Some people have this thing in their mind to where they want to benefit off of somebody's downfall. Some people just built like that. There's people that are in the stock market on Wall Street that have that mentality as well. Just so happens that some of these people are given millions and trillions and billions of dollars to manage with that mentality. So essentially, they can put up money that's not theirs and bet against companies for no reason. I mean, they got reasons, but just because they feel like they want to go against the grain and bet against somebody's downfall. So you'll have people that live in America, for instance, and they patriotic as hell. Like, I love America. I want America to thrive. I want America to be successful. I live here. I pay taxes, whatever the case may be. But their investment strategy might go completely against America because they're taking short positions on the US dollar. So they might have a hand in the dollar losing value as well, because those short positions hold weight. They call them market makers. So when you hear that term market maker, that means that you have a large amount of money. So whoever has the most money has the ability to move the market one way or the other. So when we talking about this whole Reddit thing and all that, I wouldn't call myself a conspiracy theorist. I'm just a person that doesn't take everything I hear and see. You know, I look a little bit deeper into stuff. So when you telling me that a group of people off of Reddit had enough power and money to move that price to a certain point, and then the hedge funds and they're going back and forth at it, like, we talking about a lot of money right now. You feel me? Everyday people don't just have that type of money to just be managing and put at risk like that. If I pull up the market sentiment and I look at the positions that's being taken out on a GameStop, and I can see that hedge funds have millions and trillions of dollars that are betting against this company, why would I try to put my couple $100, a couple $1,000 up against them? You know what I'm saying? Yeah, I would need a large group of people in order for that to make that happen, but that's a huge risk. So what I'm saying is the market can be manipulated. I'm not going to say that the Reddit guys won. I'm not going to say that the hedge fund guys lost. I'm just going to say that you need a whole lot of money to move the market that way. And to get all those people on the same page for one company, we couldn't even do that with the election. You feel me? So, it's just, it's questionable. That's all I'm gonna say. But just know that, everything in a nutshell, you putting risk in, and you're gonna get, the return that you want based on the money that you're putting up, and you're only gonna lose what you put in. All right. Call option buyers are bullish on the stock and believe the share price will rise above the strike price before the option's expiration date. If the investor's bullish outlook is realized and the stock price increases above the strike price, the investor can exercise the option, buy the stock at the strike price, and immediately sell the stock at the current market price for a profit. So if I have an option contract and the strike price is well below the share price, and I see that I was right, the stock price is actually going up, I'm profiting right now. I could do one or two things. I could sell my option contract and make my profit and go on about my business. Or if I wanted to be a long-term investor, I can use this opportunity to exercise that contract and buy those shares at a very low price, take on that equity, and then use that to build my portfolio. You feel me? Their profit is on this trade is market share price less the strike price plus the expense of the option, the premium, and any broker's commission to place the orders. The result would be multiplied by the number of option contracts purchased, then multiplied by 100, assuming each contract represents 100 shares. So every contract that you're going to see on Robinhood represents 100 shares. All right. Obviously, there's no commissions on Robinhood either. So that's why I say I like using Robinhood to do what I'm doing, because it's a little bit less expensive for me to deal with it if I make a mistake or not. It's one less thing that I have to worry about paying for. Dealing with speculative trading, and you got a traditional brokerage account, there are going to be fees that you have to pay. So you have to subtract that from your profit and add that to your loss. So it's a little bit easier for you to deal with a commission-free brokerage account rather than a traditional brokerage account when you're doing speculative trading. I'm also going to break down the differences between paid brokerage accounts, ones that charge commissions and ones that don't. Don't just think that because the commissions are free, that everything is just peaches. You know what I'm saying? It's definitely, they're going to make their money back in other ways. I'll put it to you like that. All right. However, if the underlying stock price does not move above the strike price by the expiration date, the option expires worthless. The option is not required to buy the shares, but will lose the premium paid for the call. So if you are out of the money and it gets close to your expiration date, you don't necessarily get exercised. You just have your contract just expires worthless. So it'll literally just disappear in your positions. You know what I'm saying? Your money will disappear and the contract will disappear. And that's it. You just took the L and you just try again next time. All right. Risk and profit from selling call options. So I think I did this already. Yeah, I did this. All right. Okay. All right. So put options are investments where the buyer believes the underlying stock market price will fall below the strike price on or before the expiration date of the option. Once again, the holder can sell shares without the obligation to sell at the stated strike price per share price by the stated date. So put options, basically, if you think the price is going to go down, you want to get a put option that's in the money or at the money. And then if the stock price decreases, then you're able to make profit. Okay. So this is a form of short selling. So if you hear somebody say, I'm short on GameStop, that means that they either are using somebody else's shares to make a profit off of the difference as it goes down, or they have a option, a put option on the on that on that company, and they're banking on the price going down so they can make a profit. So those are the two different ways that you could be short on a stock. And options, you know, you could be short on a stock. Now I'm gonna show you different ways to where you can pretty much bank on, you know, you can get money off of somebody's downfall if you want to do, if you want to play like that. You feel me? Um, Again, you know, some people want to move and invest in the way that they want their money to go. I want my money to go up, so I'm only going to bank on companies that are winning right now, so I can make sure I keep the good vibes. You know what I'm saying? I ain't got to worry about being negative or whatever the case may be. Some people are looking at it like, look, whatever the market is doing, I'm riding it. So if the joint going up, I'm riding it. If it's going down, I'm riding it. I don't care about none of that. You know, it depends on your mentality. So, you know, in my live, I was speaking about the COVID. Last time I was teaching this stuff, um, it was right when COVID hit. You feel what I'm saying? So the market was going down the whole month of March. I was making money during that period of time because that's where the market was going. Which I'm not about to just wait and not make no money. If I have a strategy and I know how to benefit off of it, I'm not about to go against the wave. You want to use a term called the trend is your friend. All right. The trend is your friend. So whatever the market's trend is, if it's trending up, then you want to ride the wave. If it's trending down, then you want to ride the wave. Now, again, some people take the concept of I'm gonna trade the way I want my money to go. I want my money to go up. I'm only gonna bet for stuff to go up. And if it's going up, I'm riding it. If it ain't going up, then I ain't messing with it. You can do that, you know, or you can use the term the trend is your friend. If it's trending, ride the wave. You know what I'm saying? If you're good enough to analyze the market and you can see where you think it's going to go and you can beat the market, not beat it, but you can time the market to where you're jumping in right at the right time, and you can jump on that wave right when it gets started. That's even better. You feel what I'm saying? So you gotta understand the difference. All right. Since buyers of put options want the stock price to decrease, the put option is profitable when the underlying stock price is below the strike price. If the prevailing market price is less than the strike price at expiration, the investor can exercise the put. They will sell shares at the option's higher strike price. Should they wish to replace their holdings of the shares, they may buy them at an open market. So basically, I already broke that down. So you can let it go once it hits your target or whatever. If you actually own the shares of the company and you're thinking about them, you're thinking about them losing value or you're thinking about them gaining value, whatever the case may be, depending on how much you spent to purchase those shares will determine where are allowing yourself to sell those shares at. So it's an option. Doesn't mean that you have to exercise the option. If you own the shares, you can put an option, you can write an option for your own shares. And let's say, for instance, I bought these shares at $47. The price jumped up to 80. But it's something going on right now. I don't know. It's weird. It looked like it's going to plummet. They saying it might go down to $2. But let me just see. Now I know I already made my profit. I don't want to let them go yet, but if I put my strike price at 80 and I wake up in the morning and it dropped to 60, nobody's gonna buy that option contract, probably. You feel me? But if you already had made your profit, you could put your joint at like 60 or 50, you know what I mean? And then the price will fluctuate between 50 and 80. It might not get exercised, but you at least protected yourself and you locked in your profits. So if somebody takes that option and buys it from you, you at least have somebody on the other side saying that they're willing to purchase your shares for $50 and you bought them for 20 something. So that's cool. And then if the price goes back up to 85 and you like, oh, no, never mind. You can buy that back and take that opportunity away from them and keep your shares. You feel me? So it's a way for you to protect yourself. And same thing if you think if it's going down or whatever, the price going down, you know, that's shorting the stock. So, you know, it's you actually own the shares, but you're allowing somebody else to make money off of yours. So you can write a put option and get paid off of that. And I'm gonna show you how to do that. And then you got other people on the other side who think the price is gonna go down. They'll go ahead and buy that contract and get paid off of it while it's going down without actually owning your joints. So I'll show you how to do that too. Their profit on this trade is the strike price less than the current market price plus expenses. The premium and any broker's commission to pay the order. So obviously, you know, you're dealing with Robinhood, you don't have to worry about commission. The result would be multiplied by the number of the option contract purchased, then multiplied by 100, assuming these contracts represents 100 shares. So the value of the holding of a put option will increase as the underlying stock price decreases. Conversely, the value of the put option declines as the stock price increases. The risk of buying put options is limited to the loss of the premium of the expiration date. So again, dealing with option contracts, you're only going to lose the money that you spent to purchase the contract. Nothing more, nothing less. Or yeah, you want it to be less, but nothing more than that. Selling put options is also known as writing a contract. A put option writer believes the underlying stock price will stay the same or increase over the life of the option, making them bullish on the shares. Here, the option buyer has the right to make the seller buy shares of the underlying asset at a strike price on expiration date. So these are options that you can use. These are I call these hedge fund trading techniques. You know, I study hedge funds. I got plenty of hedge fund books over here that I read. I take their strategies and I apply them to my portfolio to see how I can benefit without having $1 trillion in my bank account. So there's different things that you can do to utilize these options and these strategies to where you don't have to purchase the shares at all, and you don't necessarily have to. I mean, you're purchasing a contract, but you're not though. They're paying you to purchase the contract. So I can show it to you better than I can tell it. I got it written out for you. But basically, let's say for instance, you got like $5,000 in your account just sitting there. You ain't got no stocks, you ain't got nothing. There's just money in there. I can show you how to make money off of your money without having to actually buy any shares or anything. They will pay you to take on the risk of purchasing a certain stock at a certain price. So let's say, for instance, GameStop again. I think the price is going to go up, or I think the price is going to go down. There's going to be options in the chain to where you could look at the price and you can say, okay, it's at $50 right now. I think it's going to go up. I think it's going to go to 52, but I'm willing to take on those shares, but I'm not going to pay $50. I'll pay 48. You feel what I'm saying? So if I'm going to buy these shares, I want to buy them at the lowest price. I'll buy them at $48. Well, it's going to be somebody on the other side that's willing to sell those to you. And because they want to get rid of them so bad, they're going to pay you to buy them. So let's say, for instance, you agree to purchase those shares for $48 on Wednesday or next Friday. They're going to say, okay, well, you got the money? Okay, yeah, I got $4,000 in my account right now. Okay, cool. Bet. I'm gonna give you $40 up front. I'm gonna give you $40 up front if you agree to purchase these shares for $40 next Friday, right? You get that money directly in your account immediately. That $4,000 is on hold though. You can't spend it. It's just gonna sit there. But you get that 40 up front. Now, when it gets closer to the expiration date, the price done went up. The price done went up to $60 now. Him on the other side is like, oh, hell no, nah. I'm not letting them go for 40 now. Boom, you just walked away with $40. Your $4,000 gets released, the $40 gets collected, and you ain't got no shares, you ain't got no contract, you ain't got nothing. You just made $40 off your $4,000. So you can actually program your situation to where you're making income off of the money that you got sitting using these strategies. And I'll break that down too. All right, so if the underlying stock price closes above the strike price by the expiration date, The put option expires worthless. The writer's maximum profit is the premium. The option isn't exercised because the option buyer would not sell the stock at the lower share price when the market price is more. I just broke that down. However, if the stock market value falls below the options price, the put option writer is obligated to buy the shares of the underlying at the strike price. In other words, the put option will be exercised by the option buyer. The buyer will sell their shares at the strike price since it's higher than the stock market value. So again, using that example, I agreed to purchase these shares at $40 next Friday. They already paid me the $40 in premium. My $4,000 is on hold. Now the market worked against me or with me, and the share price dropped all the way to $35. They're gonna sell those to you because you agreed to purchase them at 40. So yeah, you took on a little bit of a loss, but if you really wanted those shares, it really don't matter as much. And you can offset some of that with the premium that you just got paid. So they paid you the 40. That's not a lot of money, but depending on how you play the game, you can still win with that. So if I'm in a position where I want to invest long term with a company, I'm going to use options like this. I'm going to go and see if I can write a put, you know what I'm saying, and buy the option contract at a lower price and get paid up front. And if it works in my favor and it reaches my strike price, then I can walk away with my premium plus the shares that I wanted. If it goes below, then I walk away with my premium plus the shares, and I might have took a little bit of L. But if I believe in the company long term and I think it's going to go back up, then I didn't really lose nothing. I literally just did this last week. All right. I'm still building my portfolio. I went and invested into Exxon. All right. For those of y'all that know, Exxon, they pay really good dividends. You feel what I'm saying? Even through the pandemic, they paid dividends. So instead of me going and buying that at market price, I said, I'm gonna write a put. I'm agreeing to purchase these shares at this price. I got my money up front. They paid me like $130 up front. You feel what I'm saying? Took that money, put it in my brokerage account. Then throughout the week, I'm looking at the chart and I'm like, okay, I charted my situation out and I figured that it was going to go up towards the end of the week. Either way, it's at an uptrend. So eventually it's going to go up. It's already undervalued as it is. But when you're dealing with long-term investing, if you're looking at a situation where you're trying to build a portfolio based off of dividends, the stock price doesn't matter as much because those dividend payments are going to get paid out regardless if you're going with the right company. So Exxon, yeah, I might have took on a little loss. I think my strike price was at like 40. No, it was at 46. And I think the share price of Exxon right now might be at like 42 or something like that. So a couple dollars off, but I'm in it for the long haul. And no matter what, I'm still gonna get my dividend payment. You feel what I'm saying? So I'm gonna make my money back anyway. And they're paying for, let's say for instance, if you have 100 shares of Exxon right now, they're gonna pay you around like $368 a year just to hold that stock. So that's passive income. So I got that 100 up front, and now I'm about to get another 300 something within this year's time. You feel me? So I ain't really take no L. And I'll show you how to build that out as well. The risk for the put option writer happens when the market's price falls below the strike price. Now at expiration, the seller is forced to purchase shares at the strike price. Depending on how much the shares have appreciated, the put writer's loss can be significant. The put writer, the seller, can either hold on to the shares and hope the stock price rises back above the purchase price, or sell the shares and take a loss. However, any loss is offset somewhat by the premium received. So that's what I was talking about. You're gonna get paid up front. You know what I'm saying? And if it doesn't reach your strike price, then you basically walk away with free money. If it reaches your strike price, then you walk away with free money and you get the stock. So to me, I don't really care. It's really like you can't lose because you're still getting the asset. And if you believe in the company, then, depending on what your investment strategy is, it's really like a win-win scenario. All right, so pros and cons. A call option buyer has the right to buy assets at a price that is lower than the market when the stock price is rising. The put option buyer can profit by selling stocks at a strike price when the market price is below the strike price. Option sellers receive a premium fee from the buyer for writing an option. Cons, if a falling market, in a falling market, the put option seller may be forced to buy the asset at a higher strike price than they would normally pay in the market. The call option writer faces infinite risk if the stock price rises significantly and they are forced to buy shares at a higher price. Option buyers must pay an upfront premium to the writers of the option. So if you're on the other side of this and you have those 100 shares or whatever, and you're writing an option for somebody else, you're gonna pay. You paying them to purchase your shares. You know, you could take a huge L if you're wrong. You know what I'm saying? Because you're gonna lose you can lose. You know what I'm saying? There's ways that you can structure this to where you can make money on both sides. I've done that too. You know what I'm saying? I'll show you how to do that. So where it's like a wheel. You know what I'm saying? So you coming in with money to get paid real quick. If it goes against you and you get the shares executed, okay, boom, fine, all right, whatever. I don't really want this. I didn't even want these shares, or maybe I didn't want these shares. Either way, I can go ahead and write a call option immediately for the next week and get paid up front for that. You feel what I'm saying? And protect myself from any losses in the market, or I could sell them and let them go for more than what I bought them for, or at least close to where I bought them at. You feel what I'm saying? So you could just work and maneuver off of premium. If you just want to make money off of premium, you could do that and still control the asset, you know, for half of the transactions. Real world example, suppose Microsoft shares are trading at $108 per share and you believe they're going to increase in value. You decide to buy a call option to benefit from an increase of the stock price. You purchase one call option with a strike price of 115 for 1 month in the future for 37 cents per contract. Your total cash outlay is $37 for the position, plus fees, plus commission. If the stock price rises to $116, your option will be worth $1, since you could exercise the option to acquire the stock for 115 per share and immediately resell it for 116 per share. The profit on the option position would be 170.3%, since you paid 37 cents and earned $1. That's much higher than the 7.4% increase in the underlying stock price from a 108 to a 116 at the time of expiration date. In other words, the profit in dollar terms would be at a net of 63 cents or $63, since one option contract represents 100 shares. If the stock fell to $100, your option would expire worthless and you would be put out $37 premium. You lose $37. The opposite is that you didn't buy 100 shares at 108, which you would have resulted in an $8 per share or $800 total loss. As you can see, the options can help you limit your downside risk. So you're basically protecting yourself by not putting a lot of money at risk, but then you're maximizing your gains at the same time. So if you owned 100 shares of a stock and the price went up $1, then you know what I'm saying, you made $1 profit. You feel me? But you had to invest that much just to get that dollar gain. Whereas if you had an option contract, you didn't even have to put that much money up, and you still benefited just as if you owned the shares in the first place. So you maximizing your profit without taking on much risk, and you're minimizing your risk because you're only able to lose the amount of money that you pay for the actual contract. All right. Spreads, we're gonna get into that too. Option spreads are strategies that use various combinations of buying and selling different options for a desired risk return profile. Spreads are constructed using vanilla options and can take advantage of various scenarios such as high or low volatility environments, up or down moves, or anything in between. Spread strategies can be categorized by their payoff or visualizations of their profit loss profile, such as a bull call spread or iron condor. So basically, I'm gonna get into that. That's advanced stuff, but I'm gonna show you straddles. You feel me? Because straddles are a little bit more easier to deal with. Straddles, I use those when the implied volatility is super high. I don't really know if the price is going to go up or down, but I just want to get in the game. You feel what I'm saying? So if you know that an event is coming up and you know that something is about to pop off with this particular company, and you're looking at the contract and the implied volatility is dumb high, like over 180%, basically telling you that it's gonna make a move. It's gonna be one way or the other. You feel me? I don't know which way it's gonna go. I might use a strategy like a straddle to where you can buy a call option at a specific strike price at a specific expiration date, and then buy a put option at that same price and same expiration date. So you on both sides of the market at the same time. When the event happens and the volatility comes into play and it moves in one direction, now you know which way it's going. You can cancel out the other contract and ride the wave or the other one. So you basically protecting yourself. So you're looking at it like, well, I don't know whether it's going to deal this way or that way. So I'm gonna go on both sides and then see which way it's gonna go. Okay, boom, it's going up. I'm gonna get out of my put and just ride my call all the way out. You feel what I'm saying? So that's a strategy that you can use. I use that a lot. And I'm gonna break that down too. So that's the end of the PowerPoint. Now let's go ahead and get into this demonstration. All right, so I'm gonna get into this real quick. I hope y'all don't kill me for this, but it's something that it's a huge topic right now. You know what I mean? And I'm gonna go ahead and take advantage of the topic. But we're gonna talk about vaccines a little bit. All right. Let me open up this chat. Okay. All right, cool. So I'm not gonna ask y'all what y'all opinion is on the vaccine situation. It's not my business. But this is a very important thing. Okay. Whether we feel good about it or not, the point of the matter is these are publicly traded companies we're talking about. So you can take the news for what it is. You can look at this COVID thing and say, it's real, it's not real, it's fake. I got people that passed away. I got people that got sick. I got people that didn't. I see people with masks. I see people that ain't. I got people, whatever. You know what I'm saying? I'm going to take the vaccine. I'm not going to take the vaccine. I think it's going to go do this. I think it's going to do that. This company said it worked. This company don't. It's a new strain out. Is it going to work with this one? Is all the debates. Whatever the case may be, these are publicly traded companies. These people are doing mergers and acquisitions all day. So you can look at it like this and say, either I'm going to take it or I'm not. Regardless if you want to take it or not, the U.S. is buying them. They already made a commitment. Biden said that he's going to get 100 million, whatever he said he's going to do. So whatever company that they decide to buy them from, you best believe the price is going to go up in value. Looking at an article right here on Black Stocks Tube right now, and it's saying no more than ever why Pfizer stock is a buy. I'm not telling you to invest in this company. I'm not telling you not to. But what I am telling you is people are investing in this company. I'm going to look up yahoo.com and pull up the summary on Pfizer. All right. Right here, you can go to the, let's look at profile. Trying to show you, let's see, holders. Okay. Now, these are all the companies that are invested in Pfizer right now. Just look at that. Bank of America, Bank of New York, BlackRock, you should know who that is. Vanguard Group, Capital World. These are how many shares they own. This is the value of their shares. Okay. So These are all the people that are invested in this company right now. They don't just put their money into companies that they don't believe in. It's a lot of money. They're not about to just put their money into companies that they don't want to succeed. They're gonna do what they gotta do to make sure they succeed. They're gonna do what they gotta do to make sure they get their money. It's about profit, it's about ROI, and you can look at it for what it is. You feel me? So I just wanted y'all to see that. These are the mutual funds, okay? S&P 500, okay? These are all the people that are riding on this company right now, all right? This is the stock price it's at, okay? I'm gonna show y'all how to chart. This is what is that? Lesson number 4, class number 4. We're gonna get into charting. I'm gonna pull up a chart right now. So this is a Pfizer chart. This is the candles. These are candles right here, okay? We're gonna break down the candles too. I'm gonna show you how to read these. All right. So this is my setup. All right. You'll have the ability to customize your situation to make it how you want to make it. But this is the Pfizer situation right now. As you can see, I marked out, you know, what I got going on. But you can see long term, this is a daily chart. If y'all not ready for that, we can look at the line chart. So you can look at the daily chart right now, and I'm gonna pull this out. Now you can see the movements that this company has had in the past few years. This is not a new company. So this company has been around for a while, had its spike back in '98. All right. Since '98, it's been going down a little bit. You know, started to get its rise back in 2009 for whatever reason. Sometimes what I do is I go back and I look up 2009 Pfizer and find out why it turned around. Look at the history of the company and see what moves they made, what happened in the economy, what happened in the world to make this company so valuable during this time. And then you can put your own, you know, assumptions on what you think was going on behind that. You see that it was going up ever since then. You know what I'm saying? It reached its peak in November 2018. Okay, started coming down again. Had a little drop. Back here we are, January 2020. All right. So January 2020 was here. Stock price dropped just like everything else. Then it started making its way back up. Okay. Now we in COVID. All right. Major spike here. This was December 2008. Go do some research and look at what happened during that period of time and why this company had a spike during this period. And then it had a drop off. Okay. Now we had a drop off. You can look at this. If you're an investor and you want to see what, you know, how you can benefit off of the situation, you can look at this as an opportunity to buy because there was a dip and it shows you what the potential was, which is $42.58. So you could look at it like, okay, boom, they showed me where it was at. If I look at the history and figure out why it reached this point and figure out why it dropped down, I could look at this as a pullback in the middle of an upward motion. So you see the lowest point down here was $26. This was back in March, okay? And then it reached another low point back here in June 25th, all right? That was the lowest it's been, you know, since the summer, since last summer, all right? Ever since then, uptrend, okay? Ever since then, it's been in the uptrend, boom. All right, so I had my trend line going up. Now, I could be totally wrong. This joint could go all the way down and drop all the way to zero. I don't know. But what I can tell you is they're saying you should buy it. And they'll tell you why. Pfizer stock remains a well-priced, calculated investment with a couple of aces up its sleeve. Let's look at what's happening off and on the price chart and during the drug giant or whatever, adjusted position, Pfizer stock that is aligned with those findings, and it tells you, you know, a little bit about the stock, why it is what it is. And there's a little chart here for you to look at. There's a whole lot of indicators on here. You might not be familiar with all this stuff right now, but by the end of this course, you will be. And you know, it's a little bit of detail on that. So this is the article. It's on blackstockstube.com. If you want to go to blackstockstube.com, you can use that as a guide for you to figure out how to make some plays. But I just pulled this up because it's a huge topic, and I don't want people to just be sitting on the sidelines. If you're feeling like you're a victim in this situation and they're just using you for test subject or whatever the case may be, yeah, you can think of it like that, or you can use it as an opportunity to make some money. I mean, everybody else is. They're gonna make money off of this whether you like it or not. Is all I'm saying. So this is just an example. And then you know there's other articles on blackstockstube.com you can look at, and it's just basically just tell you like, look, 7 stocks under $10 to buy for February. I don't know how clear you can get. Our culture isn't really too keen to reading. We don't like reading. We don't like sitting down reading. We more so want to be entertained and all that. But we're talking about getting money right now. I seen people in the chat in the Telegram group talking about they want financial freedom and now's the time and this and that. Okay, let's get it. So I made this blog as a platform for me and for others to use to just get money. You can literally come here and pull up the stock market news and look at the plays that I filtered out the plays for you. You feel me? So you'll see articles like this. And again, they're telling you what they think you should do, but you don't have to just go off of what they're saying. You can look at the chart, do your technical analysis, do some fundamental analysis, which is looking at the company itself, looking at who else is invested in the company, looking at their financials. You feel me? Looking at their profit and loss statements. This is amazing. $48 billion in revenue, and it only cost them $9.7 billion to make that. That's a crazy margin. And you see the margin is wider, you know what I'm saying? So again, I'm not telling you to do nothing. I'm just saying this is how I look at the plays and how I formulate, you know, what I'm about to do if I'm doing anything. Then there's actually an option chain that you can look at and you can see how many, what the implied volatility is, what the open interest is. You see it has the open interest rises closer to this number right here. So you see it's more people that got this option contract specifically than the others. I think actually this one looked like the highest one right now, $37. You feel me? Again, right now it's at $35.90. So this is for February expiration date. Now you can look at longer expiration dates and see, you know, where it's fluctuating at, but it's looking like people ain't really too far holding those contracts too far out. So the closest one for now, the highest volume is right here at 37. So when we talking about riding waves and all that, that's a wave right there. 96, you know what I'm saying? At this price, if you wanted to do it like that, you could just go ahead and get this contract. I could pull up the Robinhood. This is the Robinhood right here. You can see, boom, Pfizer, trade options, all right? You click that, and then you look at the option chain. This is the option chain on Robinhood, okay? Now you can see expiration. Where was this at? This was expiration February 15th, February 5th, $37. Let's see if we can find that. Move, yo. See if we can find that, okay? $37 strike price is right here. Okay, so back to the lessons. In the money and out the money, all right? In the money for a call option will be below the strike price, okay? Those are the most profitable option contracts. You feel what I'm saying? So you want to put yourself in a position to where you're getting a contract that has a strike price that's less or lower than the current share price. Just in case you actually want to purchase these shares and exercise the contract, you're going to purchase them at a lower price than where the share price is at right now. Okay? The lower you are in the money, the more expensive these contracts will be for obvious reasons. Okay? When you're looking at an option contract, you want to look at When you open it up and you click on it, you see the Greeks. We talk about the Greeks. These are the Greeks down here. All right. You want to look at the bid and ask spread. Okay. You want to look at the implied volatility, open interest, volume, all these things that we just spoke about. All right. Below the share price is in the money. Above the share price is out of the money. All right. If you're bullish and you believe that the share price is going to reach a high price, then you can play around with this, knowing that the higher out of the money you are, the cheaper you're gonna be spending on your option contract. So if you only want to put up $56, remember, it's 56 cents times 100. So if you only want to put up $56 and you think that the price is going to reach $40, then you can play with the out of the money contract if you want. But remember, if it don't reach that price by February 5th, you're going to lose money. And the longer you hold it, the less it's going to be worth. All right. Let me pull this up real quick. All right, cool. Sure, I see everybody. All right, so yeah. So that's in the money and out of the money. Now, you pulled up the contract and you see the delta. All right, remember the delta, basically, that's your profit right there. So every dollar that it goes up, that's the amount of profit that you could potentially make. I know it's a lot of math. I don't sit here and write this stuff down and calculate everything. Cheat sheet, optionsprofitcalculator.com. All right. If you look into the back end of the members area, you will see a list. It's a PDF where it has tools for you. All right. Options Profit Calculator is in those tools. I'll pull that up for you so you can see what it looks like real quick. All right, the back end. This is the back end. This is what it looks like right now. All right. Well, it's supposed to look like. All right, so this is what the back end look like right now. So course one, you see option trading resources in the back. Download that PDF and you'll see all of the tools and stuff on here that I'm suggesting for you. I got books for you. I got websites, tools. I got everything. Right? Everything you need right there. All right. So back to this. Optionsprofitcalculator.com. Okay. I see somebody in the chat said, how do I get my Robinhood account to let me trade options? I'm gonna go through that in a minute. Optionsprofitcalculator.com. Basically, you can use this to calculate your potential profit and your potential loss. All right. You need to be aware of everything. And this is how you get the breakdown. Okay. So I typed it in. I typed in the symbol right here. Get price, boom, that's the current price. Select option, boom. So the one that we was looking at right now, and I know some people probably hate that I'm using this option, but I'm using this option just because I'm using this option. February 5th expiration date. We was looking at the 35.5. Okay. So you want to look at, boom, 35.5 right there. Then you have, depending on, and again, this is Robinhood, so sometimes your prices are going to be different and whatnot, but you see it's $1.01 right here. Sometimes you won't find the exact price on this options profit calculator, but just find something close to it. So that way you can get a range. You know what I'm saying? So you click that one. Let's just say we're going to get one. All right. Boom. You're going to spend $101 on that. All right. Calculate. Matter of fact, let me go back to, let's just say 50 and 20, whatever. Hope I did that right. So this is where you at. Okay, boom. So this is your expiration date right here. All right. You can go down here and look at your profit loss. Sometimes people like looking at percentages. Sometimes people looking at just straight up the money. All right. So this is the money. This is the dollar value. So let's say, for instance, that we bought that contract, that exact contract that we was looking at. This is the potential loss and the potential gain. You see, you're only going to go to $101. That's how much you put up. So that's all you can lose. But look at how much your gain is. Your gain is actually infinite because we don't know how high the price could go. The price might jump up to $3,000. We don't know. You feel me? But this is a range, okay? And you only got 1 week. So we can only assume that it's only going to go up, but so high within 1 week. But if something happened like GameStop, you never know. You feel me? So let's say, for instance, you got that contract and the price goes up $3. This is where you at right here. So you see how you can multiply your money? You basically doubled your money if the price goes up a couple dollars and you only put up 100. You feel me? So let's look at it like this. Stimulus. You know what I'm saying? Stimulus check. Boom. You could turn your stimulus check into thousands if you're right. That's just using this strategy with this particular company. You don't got to use this company. How long do you keep it before selling? I can see it until the next day. You can sell it to the next day. So yeah, you can sell this at any time as long as the market is open. Okay, so the market is open at 9:30 a.m., closes at 4. So Monday through Friday, right? So the expiration date is February 5th. That's Friday. All right. So anytime between Monday through Friday, 9:30 to 4, you can sell. So if the market opens on Monday and you already had this option in your portfolio, and the stock price goes up $5, you'll see your profit right there, and you can go ahead and sell that off. Easy. Boom. Couple thousand, no big deal. Send me a screenshot. I want to see that. And that's pretty much it. So options profit calculator is what you need. Also, I want to make sure that you document everything. All right. I'm using my desktop, my computer right now. Easy thing that I normally do is if I were to purchase this option contract, I would simply take a screenshot. Boom. Keep it in my files. Get a little folder. Put everything in there. If I were to purchase this option contract, boom. Take a screenshot, put it in my folder. If I whatever I base this decision on, the news that I saw, boom, take a screenshot, put it in my folder, just so you got everything documented. So you know, okay, because 2-3 years from now, when you sitting on $100 grand or $1 million portfolio and you want to pull back some info and let everybody know how you did it and what the moves you made and all that, you could pull it up and say, look, this is why I did it. This is how I did it. This is how I planned it. And if you lose, you can also go back and look at it like, okay, boom, this is what I did. This is how I planned it. Maybe I should make some adjustments and make sure I adjust my strategy. Can you show an example of what you would do if you wanted to trade outside of the money? All right. Let's say, for instance, if you want to trade outside, so if you want to trade outside of the money, then you must be very, very confident that the price is going to go up tremendously. You feel what I'm saying? If you get a contract that's outside of the money and it goes below your strike price and below, because you got to remember, you're out of the money. So this goes into trading psychology. If you purchase a contract that's out of the money out the gate, you're going to be negative out the gate because the share price is already low. You feel what I'm saying? You don't want to bet against yourself for no reason. If you're really confident in it going like that and you just don't want to put that much money in risk, then that would be a reason for you to get an out of the money contract. But you want to be on the right side of the market at all times. You want to minimize your risk at all times. If you feeling like you want to save your money by getting an out of the money contract, then just don't even mess with this. Go to a different stock. You know what I'm saying? But that's what will happen to you. If you get an out of the money contract and it doesn't go above your strike price, then you're going to be losing money. All right. If I have an option on a stock that I'm losing money on, the strike price is 41 and the stock is ranging between 37 and 39. Should I sell it and then go back to purchase it at 37 to get the money back? So yeah, if you have a strike and you're losing and there's time on your expiration and you feel like you want to reposition yourself, yeah, you can do that. Just know that that money, whatever money you lost is gone. It's not like you can just get your money back. You feel me? But whatever you lost is gone. So if you still got money in there, like let's say, for instance, you spent $100, $101 on this one right here, and the share price starts going down, and you like, damn, I need to get up out of this. I know it's gonna go up at some point. Maybe my expiration date was too close. Maybe I need to get a longer expiration date and reposition myself at a lower price. I'm gonna sell it, you know what I'm saying? Take on whatever losses I'm gonna take, reposition myself at a lower strike price, and then and get back in the game if I'm feeling like that. What's this? I should have done more due diligence. Yeah. So if you already in this, it sounds like you already in this. If you already in this and you know what I'm saying, it is what it is. You can do that. You know what I'm saying? The market open up tomorrow and you can reposition yourself if needed, but you don't know what's gonna happen. You feel me? This news article just came out today. You feel what I'm saying? The market hasn't adjusted to this news yet. So this news is gonna hit Yahoo, probably gonna hit Robinhood app, probably gonna hit all these other apps later. You feel what I'm saying? All these other news later. News is gonna open up Monday morning. Somebody might say something on Fox 5 about it. The president might say something about Fox 5 about it. For those of y'all who know me personally and was following me on my other page, last year when Trump was going on and giving his speeches, I know how people was looking at it. Some people was looking at it, you know, like, man, I hate listening to this dude talk. Like, he always, you know what I'm saying? Da, da, da. I'm over here listening to him. I'm like, well, he gonna say something. He gonna speak a brand at some point, because that's how he moved. He was shooting brands out left and right. I don't know if y'all was listening or not, but that's what I was listening for. He was shooting out brands left and right. He shout out, man, he be shooting out brands. Every time he shoot out a brand, I go right to my options chain, get a contract, and watch that mug and watch it make money. You feel what I'm saying? It don't even really be mattering what he be talking about. But he was controlling the market. And if you wasn't in tune with it, you wasn't able to take advantage of it. Look at what Elon Musk is doing right now. Every time he tweets something, it's a movement. A couple of days ago, right after people was talking about the GameStop stuff, he changed his profile to hashtag Bitcoin. What you think happened to Bitcoin? Price shot up like crazy. You feel me? So you got to be in tune with this stuff already. Now, for me, I was already in the crypto market. My chart was already I already had Bitcoin charted out, so I already knew it was going to go up. I just didn't know it was about to do that. He sped the process up, but it was already geared to take off. You feel what I'm saying? It retraced enough throughout this month. It was bound for it to go up. He just sped up the process. So when people like that are speaking and they got large influence, you got to pay attention. If you got money on the table, you got to pay attention. So Biden might come out and say something. Only reason why I felt like it was necessary was because a couple weeks ago he said something. He said, look, we about to do this, and we about to get this many, and this how many we need, and this how many coming, and this the company that we were rocking with. He said it. So it's very clear that they are getting their vaccines from this company. You dig what I'm saying? This is one of the companies that they're rocking with. So the stock price is gonna go up. It already showed his hand. It already showed his hand right here. You feel me? So yeah, back to the question about how do you get options? Yeah, so when you download Robinhood, you're not gonna have options available for you immediately. You have to apply for it. And it's not like an application to where you gotta wait till you get approved. They literally approve you. All you gotta do is answer the questions the right way. So you go into your account settings, and then you want to go down. Let me see if I can pull it up. I don't want to show you all of my business like that. Hold up real quick. Go to your account, go down to settings. I hope you're walking with me right now. All right. Go to account, go down to settings. Slow. All right, so you on the left-hand side, if you're on the desktop, it's on the left-hand side. If you're on your app, look for investing. It's a list. It'll say account, investment profile, investing. Robinhood, you know, options trade, whatever. You don't have to. Go to investing and scroll all the way down until you see options. All right, who was that? That was Simone. Let me know in the chat, Simone, if you're walking with me. All right, go down to your settings and then go to investing. Scroll all the way down until you see options and you have to enable options. They're gonna give you a quick assessment. They're gonna ask you they're gonna ask you some questions, right? Just be smart about the answers that you give, because if you answer them wrong, they're not gonna let you do it. This is risky. They want to make sure that they're giving you the ability to to trade and like you know what you're doing. They don't want to, you know what I'm saying? So you got to answer the questions the right way. All right. Answer the questions the right way. I also have an assessment for you in the back end too. All right. Pull this up for you so you can see exactly what I'm talking about. Options, trading, resources. Go into the members area. Is what it looked like. So you download this and you'll see risk tolerant assessment right here. Edward Jones risk tolerance questionnaire, Robinhood risk management. So you can look at these three and it'll give you a brief, you know, you want to take these assessments because you want to see where you at mentally. You need to know where you at. Some people don't need to be messing with this at all. I'm gonna be honest with you. Some people just can't handle it. If you go put your money up and you start seeing your shit decrease, you're gonna be ready to, you know what I'm saying? You're gonna be ready to hurt something. Like just know yourself. So if you really don't, if you're not sure about whether you trust yourself with this or not, take the risk tolerance assessment and see where you at mentally. You know, and this is normally for like long-term investment and stuff like that. Class number 5, we're gonna get into trading psychology. So you stick around, we're gonna get into trading psychology. I'm gonna show you a couple of tricks to the trade and ways that you can kind of help yourself mentally so that you're not going crazy when you're seeing these numbers fluctuate. All right, so that was that's the difference between in the money and out of the money. Okay, if you're having a call option, you want to make sure you got buy and call highlighted. Out of the money is above the strike, the share price. In the money is below the share price. All right, you clicked on option that you're interested in. You see the Greeks here. We went over delta, gamma, theta. All right, implied volatility. See all of that. If everything's looking good to you, take that risk, pull the plug on them. Now, if you think the price is gonna go down, put option, okay? Same thing, but opposite, all right? Above the share price is in the money. Below the share price is out of the money, all right? You think the price is gonna go down, so you wanna get if you wanna get an in the money call option with a strike price that's above the share price, all right? So calls in the money is below the share price. Puts in the money is above the share price. You want to be in the money both times. That's how I feel about it. You can come up with your own strategy if you want, but I like to stay in the money just to protect myself. Somebody said this might be slightly off topic, but drip was also an option. Should we have that on? Yeah, you should have that on. We're gonna get to that though. That is part of building your portfolio. That's something that you definitely want to stay tuned for. We're gonna get into that. That's how you compound your money right there. That's for long-term investing. All right. So definitely look into that. We're gonna get into that. I'm gonna break all that. That's class number. That's class number 4. All right. So puts. All right. The exact opposite of a call option. You think the price is gonna go down? You get a put option. You profit on the way. Ride that wave. All right. Same thing. Everything is opposite. So you see the negative numbers. You see it's red and all that. The delta is negative. You know what I mean? Oh, back to the option thing that I was talking about. So, okay, I can't use this one as an example because the implied volatility is very low. But just imagine if this implied volatility was at, Just imagine if the implied volatility was at like 180%. Right? And I don't know whether it's going to go up or down. That would be me buying this one and then going back to the call option. Pulling up the call option.
You trying to eat?
No, she said one
And
door.
getting the same, somebody got to mute themselves. I got you. Don't worry about it. All right. So yeah, so you're basically getting the same option on both sides. Boom. All right. So boom, you see it popped up, straddle. You feel what I'm saying? So you got the same one on both sides. So you're playing both sides of the market. You feel me? You see the spread between the prices right here too. So you add these both together, and that's how much you spending times 100. So you paid $160 for both of them joints. So you ain't really put too much. It's not like you doubled your risk. You feel what I'm saying? Because the put option was cheaper. You feel me? Because it's like, you know, it's and that'll also tell you one thing too. It'll tell you what side of the market to be on. If the joint is more expensive, then that kind of lets you know that it's more valuable. So, you know, but if the implied volatility was super high and you had no idea on which direction it was going to go, you could use that option and then wait to see what direction it goes. Now, if it starts going up, you can go ahead and cancel it, not cancel, but you can get out of that contract and ride the win in, win out until it hits your target price. But you will lose on one and win on one, right? Yeah. So you're gonna definitely lose on one, but you want to catch it. It's timing. You feel me? If you're paying attention, and this is for people like if you don't have time to sit here and look at the market, you know what I mean, and watch it, then I wouldn't even suggest this because you got to be able to get in and get out. If you really want to hold long term, you know what I'm saying, don't use straddle because you know you don't want to end up canceling your wins out. If you hold both of them and one is going one way and the other's going the other way and you don't do nothing, then you basically just gave your wins back. So you want to cancel it out. With the straddle, can you keep one without getting out of the other? Yeah, exactly. So you want to get rid of the one that's losing ASAP. So advanced strategy, right? This is writing. Okay. When you get this, when you're on this side of the market, when it says sell, that means you holding something. You either holding some bread or you holding some actual stocks. So if you got 100 of these shares already, let me get this out of here. My bad. Hold on one second. Let me get this out. All right. So let's say, for instance, that you have 100 shares, and you either want to protect your position or you want to make some money off of your premium, right? You want to write an option, okay, and give somebody else the opportunity to profit off of the movement in the stock price, okay? So, or you want to sell your option at a specific price regardless of what happens to it in the future. So let's say, for instance, there's an event coming up and you think the price might go down and you bought it at 35. You executed this joint. It's a whole week later and you got now you actually have 100 shares and you bought them at $35.50. You think the price is going to go down below that, but you don't want to risk your holdings and lose out on your bread. So you go ahead and write a call option for a higher price. You dig what I'm saying? You can write your call option at a higher price and make $38 up front because the person on the other side is going to pay you for the opportunity to purchase your 100 shares at that specific price. All right. If the share price reaches that particular point or stays below that particular, or if the share price goes above or at that strike price, then more times than not, they're going to take those shares up off you because they're getting them at a discount or they're getting them at the price that they agreed to buy them from you at. So you're going to get that gain, which is the difference between the $35.50 that you paid for them and the $37. So that gain, that spread, you're going to get that, but you also going to get that $38 up front too. You feel me? And then and then your shares will be gone. If the share price goes well above the strike price that they agreed to purchase them at, then they probably, you know what I'm saying? They might not exercise them. You know what I'm saying? Or you can give yourself an opportunity to buy them back. You feel me? So I had this example on my highlights. I told everybody to look at Virgin Galactic probably like a month ago. You feel me? Let me pull it up in my chart. I told everybody to look at Virgin Galactic. All right. Told everybody to look at Virgin Galactic right around this time. You feel me? I told my friends, of course, but I also posted it in my stories and my highlights. All right. So for those of y'all that don't know Virgin Galactic is, you know, they have, you know, their phone companies that they had or whatever, but Richard Branson, you know what I'm saying? He's an entrepreneur, you know, he got whatever idea he want to go with is what they rocking with. So now they want to go outer space now. So they launch it. You feel what I'm saying? So they had their first launch back here. When they announced their first launch, look what happened to the stock price. It went up. But what happened during the launch though? They didn't make it. It didn't explode or nothing. They just didn't reach their destination, and they had to come back basically and cancel the situation and look at what went wrong. So they had to go back to the drawing board and examine it, look at what went wrong. You feel me? And then they're gonna plan a launch in the future. So when the stock price dropped, I looked at it like shit. They didn't say that they was gonna stop trying. You seen what happened when it went up when they announced it last time, and it didn't make it, so it dropped. So I'm looking at the situation like, well, as soon as they say that it's going to go up, they're going to try again. The stock price is going to bounce again. So, hey, y'all should look at Virgin Galactic. The signal is SPCE. Check it out. I know I bought my contract, but I didn't buy the shares. I actually wrote a put. So let's get into that. So I wrote a put contract. All right. Sell, put. Okay, I had the bread available. All right, whatever share price you pick, you have to have this strike price times 100 in your account. You feel me? So if you got the money available, you can write a put and get paid premium up front. Let me go back and take this off. Make sure we. All right, so let's say for instance, I think that this share price is going to go down or go up, whatever I think is going to do. I want to make sure that I'm in the money. So where did I buy it at? I'm gonna just use the example that I had, 27. Obviously it's probably not going to show you the exact premium that I could have got at that particular time, but just an example. All right, so I had it at 27. So you see the price now is crazy. But let's just use this as an example. What I did was I bought them where I was actually in the money. When you're in the money, writing a put, the premium is going to be higher. But you got to be right, because if you don't want the shares and you get exercised, then you got some equity that you didn't really want. You know what I mean? You spent your bread. But if you want to make sure that you don't get exercised, then you want to make sure that the price, you put yourself in a situation where the price doesn't reach your strike. You feel me? So just look at it like this. If I own 100 shares of this company, I don't want to sell them for you for less than what I bought them for, because I'm losing money now. You dig what I'm saying? They're going to only let them go if the person on the other side is agreeing to buy them for more than what I spent. You feel me? So if I get this contract right here and the share price goes all the way up, they're not going to let me get that. They're going to pay me this premium, all right, which is $485 up front in my pocket right now. And I have to wait until this expiration date to see what happens with the share price. Now, if the share price goes all the way up to $48, $50, then they're not going to let that go. I'm gonna just take this $485 plus the money that I had up in collateral and go about my business. I just made a free $485. You feel me? If the share price goes below my strike, then I keep that 485 and I actually get those 100 shares. Now, the one that I did was I got a $27 strike price. All right. My option contract got exercised, okay? And I took those 100 shares. Then the hold up. Then the share price skyrocketed. Right around the time where it got right here, I made a whole bunch of money off the actual shares, but I don't care about investing in this company long term. You feel what I'm saying? I don't care about investing in this company long term for obvious reasons. They don't even got no, they don't pay dividends like that. So why would I invest in this company long term when they ain't paying me for it? I'm not about to just get them my money for what? You feel me? Yeah, I got profit off of the actual movement, but I don't know what this company is going to do in the future. This joint might drop like it did last time. You feel what I'm saying? So some news had came out to where they had made an acquisition and they had did some things in the business to make this price jump up like crazy. I just happened to be at the right place at the right time because my strategy was looking at it geared towards the actual launch. I wasn't really worried about nothing else but the launch. They ain't even announced the launch yet. They announced something else and it made the price go up. I was there and I told everybody else to be there too. You feel me? Some people that was, I'm pretty sure there's at least one person in here that took advantage, but most people didn't. So when it got to this point, I had made my profit and I was like, all right, bet, you know what I'm gonna do? I'm gonna protect my position and write a call option to let these shares go at a specific price, okay? Let me see. I'm gonna just tell you what I did. I wrote a call option to let them go at $29 per share. You feel me? Now, some of y'all might say, yo, you tripping. You just took away all of your potential gain. The price went up to $44, bro. Yeah, the price did go up to $44. But again, I don't care about this company. I wasn't really trying to look at keeping these shares long-term anyway. So what I did was I wrote a call option and got $1,000 up front just to give somebody else the opportunity to purchase them shares at that strike price at a later date. It hasn't reached the expiration date yet. So I could still buy them back. I could still buy that contract back and keep the shares if I want them to, but I got $1,000 up front. You feel what I'm saying? Type of one if y'all understand that breakdown. And yes, this class is going to be recorded. All classes are going to be recorded. And you'll have access to this unlimited. Okay, so y'all get that. Okay, cool. Just so y'all, I just want to make sure y'all understand that. So not only did I profit off of getting the actual the contract and then getting the shares, all the gains, I'm letting them go for more than what I bought them for. And I got paid up front just to write the contract to give somebody an opportunity to get it. So that $1,000 that I got that up front in my account immediately. And I used it to go make another play. When you buy it back, you don't have to pay the upfront money. When I buy the contract back, I have to pay for the contract. The contract, remember, as the share price goes up in value, the contract is going to be worth more money. So I'm going to have to spend my bread to get that back. But if it's worth it to me, I'll do it. It's not really worth it to me. I don't care. I can make another play tomorrow. But I got that stack though. You feel me? That's really what I cared about. Anybody got any questions? And you can unmute yourself. I'd rather you unmute yourself to ask the question because this is a recorded call, so I know people gonna have. Go ahead.
I have a question.
Go ahead.
So is it a difference or a reason why were you just trying to help out other people
by offering the contract, make the money up front and offering the contract at that lower price point, which still made you money, but was still very low compared to the price of the stock? Or was there another reason why you didn't just sell at the higher price if you didn't want the stock?
So I was doing one or two things. I was locking in my profits because, again, I don't remember, my strategy was banking on them talking about the launch, going to outer space again. The news that dropped didn't have nothing to do with the launch. So my understanding was this shit could drop all the way back down. I don't even know what the significance of, you know what I mean? It was good news, you feel me? But again, look at the history, and that's why technical analysis is important. Look at the history of the company. This is a little like Tesla. You feel what I'm saying? It could be way overvalued is what I'm saying. So if this price got chopped in half, nobody would frown about it. People don't even really know about it. You feel what I'm saying? So I wanted to protect my gains by writing a contract for a future date. Again, the expiration date hasn't reached yet. My expiration date is way out, July. You feel me? So between this time and July, this price could go all the way down to $7. But they already agreed to buy it for 27. Oh, I'm sorry. How much did I say?
29.
29. Yeah, they already agreed to buy the shares at $29, regardless of what happens to the share price. So I just protected my gain.
If they ask to exercise it, or if they want to exercise it, is that when you would have to buy it back, or do you have to sell it to them if they try to exercise it and you're not ready?
If they try to exercise it, I gotta let it go. I made that agreement.
Okay.
But they already paid me $1,000 up front, plus they're gonna buy them for more than what I bought them for. So I made profit either way.
Okay.
So why did you put your expiration date so far out?
Because I want to see what happens. Remember,
do you use a scale or a gain? What type of scale do you decide when you're setting an option or put call as far as a date range? Do you do a 30-day date range? Do you do, like some of these that you were using earlier in the example were a simple week?
Yeah.
But
yeah, I'm gonna
how
tell
do you decide?
I'm gonna be 100 with you. I wanted to pay some bills.
Okay.
So I extended the month because the farther out it get, the more money I get up front.
Okay.
You feel what I'm saying? So I put what was my expiration date?
July something.
July, what's that? I'm tripping. July 16th, right?
Mm-hmm.
So, damn, why is it tripping like this? July 16th.
Right there.
Look how much bread they're giving out. Let's just say I pick, you know what I mean? If I had this one, boom, that's money up front. That goes right into your account right now. Pay some bills, went on about my business. I don't care. You can have the shares, whatever. I still get the profit on top of that because I bought them for less than what I'm giving them to you for, and you paid me up front. You dig what I'm saying?
Yeah, makes sense.
Yeah. So that was the science behind that. It was protecting myself from losing in case somebody do something stupid, because you know CEOs and all that get fired left and right. You know, companies do dumb things, whatever the case may be. They still gotta they still have to launch. They still have to, you know, they still have to conduct business up until this point. Something can go terribly wrong with this company and the stock price could drop all the way down to $18. I don't lose no money because they already agreed to buy them at 27. I got paid up front. I got to handle my business and I get to move on. You feel me? If everything goes smooth and the stock goes all the way up, then the other person on the other side, they get to get all of those gains. That's cool. You know what I'm saying? That's fine. I done already moved on to something else. It's whatever. If I feel like I really, really want it, then I can go back and buy the contract back and take it and then wait and hope that it continues to go up after I bought it back. You feel me? But
in order for you to buy it back, you'd have to pay them at the $27 rate for those 100 shares.
No, there's a premium for that.
You
feel what I'm saying? Let me see if I can pull it up real quick.
And you write that into your contract?
Nah, so so you'll have the you'll have the options in your portfolio. It'll show you where you're at. You feel me? So as the stock price goes up, you'll lose value in the contract that they have. So you can look at the contract and it'll show you how much it'll cost for you to get it back from them. So I could tell you right now, if I wanted to buy that contract back from them. All right, so I gained 1,700 just from owning those shares. If I wanted to buy that contract back from them, I would have to pay $21.45. I had to pay $2,145 to them to buy that contract back. I would only do that if I knew for sure that the share price was going to continue to rise. Because if the share price continue to rise, I'm gonna make that money back right away. Because I'm already profiting 1,700. So you feel me? You minus that, and that's really how much you have to sacrifice. But if you know that the share price is going to continue to rise, again, they still haven't announced the launch yet, so the share price could go up. I still got the opportunity to pay them to get it back, but now I already got my profits. So I don't really care. But if you find yourself in that situation, you will have the options to buy that contract back and keep those shares if you have them. All right. Anybody else got a question?
My question would be, if the important part of the options trading is the analytics and the research for the actual websites that you're going to get into, why is that class number 5?
It's class number 5. Well, to be honest with you, the technical analysis is class number 3. I wanted to go over technical analysis after I did risk management. Risk management is the next class. So risk management, I'm gonna break down, how to handle the money. Today was an introduction just so you understand how to do it. I'm not telling you to go out and just do this now. You know what I'm saying? This is a class. So if we got 5 classes, I'm expecting you to go full steam ahead after the 5th class. But if I'm giving you enough to where you can maneuver now, then you can. But I'm not expecting for you to jump in and nosedive in until we get through all of the lessons. But I'm gonna give you a little bit of everything along the way. So we went over a little bit of technical analysis, but technical analysis is very it's very in depth. We're gonna go over candles. You know what I'm saying? We're gonna know teaching you how to read these things. Like all that stuff is gonna take some time. We already been on here for 2 hours. You feel me? I'm gonna be on here all night. It's 5 p.m. Sunday. I trade odd USD on Forex. The market just opened, so I'm really ready to just get some money right now.
So is Forex, are we gonna cover Forex in this class as well, or is that a separate class?
No, that's a separate course. We're gonna go over Forex after we get through with this options. All right. Forex is deep. Forex is.
But that's international, correct?
Yeah.
Yeah, that's what I want to do. All right, cool.
Yeah, we got that coming up. And the stuff that I'm teaching you now will be applied to Forex. So when we talk about this candle reading, technical analysis, fundamental analysis, you're going to be able to combine all this information and apply it to the Forex class. So you're going to be ahead of the game if you're starting from scratch. You need to know all of it because what's going to happen? The stock market is going to crash again. You feel me? I don't want to scare nobody, but I'm just keeping it G. The stock market.
It is. It's going to be in 2021 too.
It's going to crash. You feel me? And a crash don't necessarily have to be a crash. It can be a correction. You see stocks like this going all the way up, it has to correct itself at some point. You feel what I'm saying? So when there is a correction, y'all will be able to take advantage of it the same way I had people taking advantage of it the last time. You feel what I'm saying? And when it bounces back up, when they start talking about that V-shaped recovery, you're gonna be getting, you know what I'm saying? You're gonna be getting the money. So yeah, we're gonna go over technical analysis on class number 3 because it is very deep, and it's gonna probably take about 2 hours to get through all that. And you can still make it happen without it. So when I first learned how to trade options, I didn't know technical analysis, and I was making thousands. You can actually eat off of trading options simply using fundamental analysis, which is just using the news. So again, I was reckless enough to look at an article like this and it say buy, and then I use another strategy, which I'm gonna go over with you right now. I'm glad you reminded me because I completely lost my train of thought a little bit. Hold up, we can go over that real quick. All right, boom. This is in your tools, right? I want y'all to look at this. Earnings whispers, okay? Some of y'all saw me put this on my Instagram stories, right? Earnings whispers, okay? If you have Twitter, follow them. If you don't have Twitter, just, you know what I mean, bookmark this profile, okay? This is another one where this is how you get the money. All right, look. Every single month, they post a calendar to let you know what companies have an earnings call, okay? Earnings calls, basically every single company that's publicly traded on the market has to announce their quarterly earnings every quarter, okay? They usually put out a schedule to let you know ahead of time when it's coming, all right? Earnings Whispers is one of the only pages that'll give you an actual calendar that you could print out, post in your office, and look at it. So you see in the calendar right here, letting you know which companies are announcing their earnings. Remember when I said implied volatility is important? Implied volatility comes into play when the when the companies start getting closer and closer to their earnings dates. So what's today? Today's the 20th. Okay, boom. So you got this week coming up, right? So this week you got Pfizer, Exxon, Chipotle, EA Sports, Aflac, Humana, Shell. These are all companies that we're familiar with. These are companies that we probably spending our money with right now. All of them got earnings calls coming up this week. Now, I just showed you about Pfizer. They got an earnings call on Tuesday. Look at the article. This was before I was doing technical analysis. So before I was doing technical analysis, I was looking at the earnings calls and looking, okay, boom, Pfizer coming up on Tuesday. Okay, boom, damn, my article just dropped. They saying I should buy. Okay, bang, let me pull this up real quick. Okay, let's see. Okay, boom, you got Pfizer here. This is the company. Oh, they pay dividend yield. So maybe now I can look at different strategies now. If I want to do a naked put, which is basically what I just went over, the naked put or the cash secure put. I got some money available. If I get exercised, at least I get 100 shares of a company that pay good dividends if I want to invest long term. But if not, I'm gonna look at the news and see what they talking about. Okay, earnings right here. They saying that they think it's gonna drop from last time, you know, okay. Mixed reviews here. I could pull up my Robinhood and see what time it is on Robinhood. Scroll down here and look at what they say. You can scroll all the way down. You see earnings right here. Boom. Look at it. Okay, they think it's going to drop a little bit. Estimated 0.49 per share. Available February 2nd, letting you know what time it is. You can actually listen to the earnings call by clicking this button and logging in. You can hear them talk about it in real time. So you can know where your money, what's going to happen with your bread, right? All right. Telling you what the fair value is at 40, letting you know what they think you should be doing, buy, hold, sell. All right. You could take the news that's available and formulate a plan on what you think is going to happen. As it gets closer and closer, you'll see the implied volatility rise, and then you can make a play. That's what I was doing without technical analysis. So I'm showing you this to let you know that if you want to get it popping, you can get it popping before we start going over technical analysis in class number 3. All right. If you want to use the fundamental analysis, you can make some money doing that. just by going off of what they suggest you should do. Okay. Another thing that you can go to, and I'm gonna go back to this again. This is the monthly. All the companies are not listed here, but these are the big companies that they already know about. Now, if you scroll up, every single week they're gonna update you. So what you can do is you can follow this page and you can turn your alerts on so that every time they tweet something, you can get an alert. All right. Scroll down, boom, they got this week coming up. Monday, these are the companies. Tuesday, Wednesday, Thursday, Friday. All right. Amazon, Pfizer, Google, Chipotle, UPS, Exxon, all these companies got an earnings call on Tuesday. That's a lot of money that could be made. This whole week, look at PayPal. What you think they about to do? Up or down? Pinterest, up or down? Spotify, up or down? eBay. This was before I learned technical analysis. So just using, simple logic, you can kind of gauge what you think is going to happen now. You can take your simple logic, and then you can take your simple logic and go and pull up yahoo.com and look at what everybody else is saying too. Look at the prediction here. Look at the prediction on Robinhood, and place your bet. Use the option profit calculator to judge how much money you want to put in and how much money you think you can potentially make, depending on the movement that could happen. All right. I'll start posting these earnings releases in the group chat as well, just to keep y'all in tune. All right. So what I do every week is I print this out. And then I go over it with my highlighter and circle the companies that I'm looking at, take my time, do my fundamental analysis, find as many news articles as I could possibly find, look at their financials, look at their previous earnings calls, look at as much as I can to see what I think is going to happen with the call. Because after the call is over, the market is going to start reacting. So when the call comes and the CEO come up on stage and say, man, we lost a lot of money this quarter, but we got a good future ahead, and they always gonna dress it up. The market is gonna respond to that call. So when the call is done, people gonna go to their portfolio, buy and sell. You know what I'm saying? If the call happened to be good and the earnings estimate gets beat, then normally the stock price will rise a little bit. It might not be nothing crazy, but again, you're trading options. So every cent is almost like $1 gain for you. You feel me? So like, the stock price rises, you can let yourself, decide how much you're willing to hold on to that option before you sell it. So you got to make a decision on how much money you want to make before you get in. You feel me? If $444 is enough for you, then once you get $444, don't get greedy. Get your money and get out. Because some people be like, oh, damn, it hit my target quick. Let me hold on to it. It's probably going to keep going up. Get greed will get you smacked. And then you're going to end up losing money and you're going to be mad. Set your target first. Once your target gets hit, take your money and get out. Don't get greedy. You feel what I'm saying? And don't get greedy to the point to where you take your money out and then the stock price start going up and you jump back in and try to because you didn't analyze all that. You spent all your time analyzing this price. You feel me? So take that price and get out. You didn't analyze to get 26.94. So you trying to jump back in and get another contract because you think it's going to keep going up by that date. That's how you lose your money. Y'all understand that? We're going to go over that again on the next call, risk management too. All right. So there you go. That's a play. That's a strategy for you that you can utilize. All right. Earnings calls, okay? Last when COVID first hit, I made a whole lot of money off of earnings calls. Just know that this is a strategy. You ain't gonna be the only people trying to use this strategy. So when you're dealing with strategies like this, sometimes they work, sometimes they don't. Sometimes they work like a charm, sometimes they Just know that it can be very, very good for you if the volatility is high. So let's say, for instance, I want to look at Chipotle. And I'm like, oh, Chipotle, they about to, yeah, that earnings call gonna be good. And I go and get look at options contracts for Chipotle, but the volatility is mad low, I don't know if I'm gonna really put my money in because I don't know what anything could happen. You feel me? I really like looking at a good volatility. So let me go over this as an example. Chipotle, you know, it's expensive too. So you're putting a lot of money at risk dealing with this. You know what I'm saying? Let's say I think it's gonna go up. You feel me? I'm looking at an in the money call option. All right. Volatility is at 60. You feel me? This is my delta right here. Theta is trash. That number is actually, you know what? That number is okay because it's negative. So that's fine. But look how much it's gonna cost for me to play. You feel me? It's gonna cost me $5,000 to play. I don't really want to play that game. You know what I mean? So you gotta use judgment, your judgment when you trying to figure out what game you want to play with. You feel me? I like to look at undervalued stocks with high volatility and, you know, somewhere where I could, it's almost like a clear bet on what direction is going to go. You know what I mean? If I lose, I lose, but at least I know that I ain't put $5,000 up. If I got
I have a
$5,000
question.
risk, then cool, but yeah, go ahead.
On the Robinhood app,
Yep.
finally got the options enabled. But the question was dividend reinvestment or DRIP, which somebody who talked about earlier. Do I enable that or I leave it disabled?
Go ahead
I'm a
and
Robinhood.
enable it. Go ahead and enable it. It's not going to hurt you. It's not going to take your money, nothing like that. It's a good thing. I'm going to break that down. So
All right.
dividend, just to let you know, dividend reinvestment plan. Basically what that is if you own shares in a company and you're getting paid dividends, the dividends will automatically get reinvested into the company. So you're compounding your money. So let's say, for instance, you own 100 shares in a company and they have, let's say, for instance, the share price is $5, right? And you got a dividend payments from them and they paid you $5. The dividend reinvestment plan will automatically take that $5 and put it towards buying more shares. So now the next time you get paid a dividend, it's going to be more money automatically. That's how you compound it. That's how the rich people compound their money. That's why they say true investors don't just sell out of fear. They hold on because if you have a good company and you invested in a good company, the dividend payments are still going to get paid regardless if the share price goes up or down. So you still getting paid. So really, you want to hold your shares, and if the share price drops, you want to buy more shares now. You want to buy more shares now. So when the price go back up, your dividends increase and your profit increases because your holdings have more value. We're gonna go over that in class number 4. You got that?
Every class is going to be on Sundays, correct? For the next 5 weeks?
Yep.
All right.
Yeah, for sure. All right. So anybody got any questions?
No.
So I'm sorry. So if I wanted to do a call option on Pfizer and it's $35.89, to be safe, I would try to find a strike price like at 34 in the money just to be safe. Is that right?
Yeah, if you think it's gonna go up, you want to get a call option in the money.
Okay.
Just get a call option that is first of all, it depends on your budget and your risk tolerance, but use the options profit calculator. All right.
Okay.
So plug it in here
Mhm.
and then look at the expiration dates and fluctuate and just play around just to see like, okay, you know, which one did you say? You said
I said like $34,
and then
34.
expiration date, you don't want something so close. So, you know, expiration date should be a little far out because we don't know what's going to happen with the company and how long it's going to take for them to grow. You know, keep it far out and then fluctuate with these prices. All the prices that are in the money are up here.
Okay.
You feel me? You know, puts, they all down here. So, you know, make sure you fluctuate to see, you know, you need to know what your profit is going to be.
Okay.
You feel me? So you want to look at the profit and see like, okay, I want to make this much, or I think it's going to reach this price. Now we can go back here and look. We can go back here and look at their fair value is $40.
Mhm.
You know, that could be right, that could be wrong, whatever, but it's here for you. You feel me? So if the fair price is $40 and you get a strike price here, then you might, you know, this could be your potential profit range.
Okay.
You dig what I'm saying? If it
Yes.
reaches its value. So that's how you want to look at that. Play around with that calculator.
Okay. Thank you.
Yep. Anybody else?
Yeah, I got a question.
Yeah, go ahead.
So if I plug in numbers to the profit calculator and it pulls up calculator found no risk, this can be due to low or high implied volatility or out of date prices. What exactly does that mean?
What did you do? Make sure you, oh, I'm sorry. Maybe I skipped this. Make sure you have the right things selected, okay? So when you're in your calculator, if you want it to be long, you want to be long on that, which is a call option, you think the price is going to go up, make sure you select long call. If you think the price is going to go down, make sure you select long put. If you're dealing with the naked puts, which is the covered puts, which is the cash secured puts, if you got money set aside and you just want to make money off the premium, make sure you select the right option. All right. Did you select the right option first?
I put it into a put spread calculator.
Yeah, that's it. You're doing something different.
Okay.
Yeah, make sure you select the right one so you can get the right calculations.
All right. Thanks.
You see, so I'm glad you said that. So you see all of this, right? You see all these strategies, right?
Mm-hmm.
We just went over this right here. That's all we went over today. You
Yep.
feel me? And we also went over this straddle. All right. But y'all should go ahead, you know, now that you got the basics, take the basics, master those, and then go into the advanced strategies. You don't want to try to master everything. You want to master something first. So if you want to focus on long calls, focus on those first. Master that first. You know what I'm saying? If you want to get into the shorts, master that. You know, take your time. Don't be trying to do too many things because you can mess yourself up. And I don't suggest anybody take out more than one option contract at a time starting out. One at a time. One at a time. Me personally, I still do one at a time. I don't be having 3 or 4 or 5 different option contracts. Plus, when you're on Robinhood, if you have less than $20,000 in your account, you don't have the option to trade all day, every day. You get 4 or 5 trades per week. Okay? 4 or 5 trades per week. That means you can buy an option and you can sell an option. That's one. So if you take 3 positions and you buying and selling and you go beyond the amount that they're allowing you to, you'll get flagged for pattern day trading and they will put your account on hold for like 30 days. They don't want you to be doing all of that. All right. So sparingly use your thing. I'm gonna show you what it looked like so y'all not in the dark. Hold on one second. Account. Go to your account, go to settings, go to investing, scroll down. Matter of fact, hold on one second. Options trading. Yeah, so when you open up your options trading, you should be able to go and look and see what your preferences are. And hold on one second. Investment profile. Okay. I need to put this up on my phone app. Hold tight. I need y'all to know this because we got people getting flagged with pattern day trading and they can't do nothing. They get taken out of the game. All right. All right. So you go to your account and you click on investing, scroll all the way down, and it's going to have day trades on there. You got 1, 2, 3, 4 circles. I protect myself and use the go to day trade settings and turn it on so that it can protect me. So it won't let me go beyond the 3 that they allow. You feel what I'm saying? Once the 5 days is up, they'll get erased and you can start over. If you want to bypass this, you can deposit the right amount of money in your account and they'll let you do whatever you want. So if you put 20 grand in there, they'll let you do whatever you want. But anything less than that, you got limits on how many day trades you can make within a week. All right. So you got to be, you got to be accurate about, what you're trying to do. Don't go too crazy and be trying to make too many plays within a week. All right. Anybody else got questions? Y'all good? All right.
Good start.
Yeah, good start. All right, cool, good. I'm glad we got everybody in. For those of the people that missed it, man, if y'all got family, friends, or whatever, y'all think that they need to learn this, go ahead and put them on. And I'm gonna keep in tune with y'all in the chat. Make sure you turn your notifications on for when I go live on Instagram. And I'm gonna start putting stuff into the Telegram group here pretty soon. Make sure you go into your back end and and get the options trading resources. By tomorrow morning, this class will be in the back end. So you'll be able to go up and look at the recorded class, all right, and watch at your own pace. But options trading resources is here. Make sure you download that and use everything that I'm giving you. And everything that's in there can be applied to pretty much every class. Everything that's in there, I haven't went over yet. So just know that it's all in there for you when it's time to use it. All right. Blackstockstube.com for your plays. Easy ways for you to get some bread. I filtered out, the stock market news so that you can look and see what's out there for you. And then let's go ahead and get this money. All right. Y'all have a good evening. Peace.
Thank you.
Have a good night.
Thank you. Have a good night.
Thank you.
Thank y'all.